Hey, this is Chris, and in this video I'm going to be talking about inflation, and specifically what inflation means for your investment portfolio. Now, just to recap, inflation basically is the gradual increase of prices over time. In Australia, it's measured by the Consumer Price Index, or CPI, and it has other measures in other markets around the world. It's not something people have really talked about much over the last 10 years because since the financial crisis, inflation around the world has actually been quite low. In most countries, the central banks target an inflation rate of 2 to 3%, which is the healthy inflation rate for an economy. But a lot of economies have seen inflation fall below this target range or sort of sit at the bottom of this target range, which has led to policies that have tried to stoke more inflation. Now, recently, since the COVID crisis of 2020 and the stimulus that governments and central banks put into markets after that, there's been increased concerns or fears about increasing inflation over time. Now, what does this mean for savers, first of all? Well, that is quite obvious. If you've got money in the bank, inflation is a terrible thing because it means that the value of your money or what you can purchase with that money is eroded year after year. So it's quite obvious for some people what inflation means. For investors, it's a little bit more mixed. So in this video, I'm going to be focusing on that. Certainly over different periods of time in history, inflation has been good or bad for markets. There have been times where inflation's been good and bad. The reasons that determine this are things like whether inflation can be passed on to consumers, so things like wage growth, as well as general economic growth. And therefore, inflation itself won't tell you whether markets are going up or down, but it can give you some hints around what sectors of the markets may perform better or worse. So over the last 10 years or so, one of the sectors of the market that has performed quite well are technology shares and high growth shares. These are sectors of the market that do well with a low inflation environment, basically because their high growth is producing bigger and bigger cash flows into the future. And if inflation is quite low, then discounting those cash flows to today's values doesn't lead to a big change in what those values are. And so you're basically discounting big cash flows into the future based on low inflation, and that gives high growth stocks very high values today. And that's what we've seen over the last 10 years is very high values being attributed to companies with good growth rates. Now, if we come into an environment where inflation increases, the sorts of companies that tend to perform better does change because your earnings growth tends to be less important and less impactful because of inflation eroding those future returns. So historically, when there has been periods of higher inflation, the types of companies that do better are, for instance, commodity producing companies in Australia like BHP or Rio Tinto, because they're pulling out of the ground the things like copper and tin that are increasing in price, as well as emerging markets as a general market area, because they tend to be countries that are high commodity producing countries. They also have the secondary benefit of high inflation because it helps them inflate their way out of debt. And usually their debt is denominated in US dollars, and US dollars tend to fall when there's high inflation. So this is also beneficial for emerging markets. And the third area that tends to do quite well is gold. Now, when we had a huge period of inflation in the late 70s and early 80s, one of the biggest beneficiaries was the gold price. So what we may see in markets and what we've started to see is a bit of an inflection point in the types of companies performing well. Tech shares have started to perform less well than they have recently, and some of these commodity shares, emerging market shares, and gold companies have started to perform a little better. And in fact, the possibility of future inflation is one of the reasons why we recently rebalanced the Stockspot portfolios. We took a little bit out of government bonds, which tend to do very poorly if there's high inflation, and deployed this money into emerging markets and gold, which are two areas that tend to do much better during different types of inflation, whether that's stagflation, where there isn't a lot of growth, or inflation, where there is also growth. So what do you need to do as an investor if there's inflation? Well, my tip would be that you just need to diversify. So unfortunately, even if there's inflation, it won't tell you exactly what companies you need to buy because inflation can come in different types of environments: high wage growth, low wage growth, good economic growth, poor economic growth, rising margins or falling margins. So you still need to diversify, but you need to be conscious that Areas like government bonds are likely to perform poorly if there's inflation. You might want to consider inflation protected bonds, which is a theme we offer at Stockspot, but also gold tends to perform similar to inflation protected bonds over the long run, so is likely to perform better than government bonds in a period of rising inflation.